trading psychology and profitable consistency, mastering the inner game. Welcome, ambitious minds, to Inspire 7, the place where the pursuit of high performance meets the undeniable power of inner clarity. It's a privilege to connect with you today as we delve into a domain where success is less about what you know and more about who you are. Today's topic dives deep into one of the most misunderstood, yet absolutely critical, components of long-term trading success: trading psychology and profitable consistency intelligence. Ask any seasoned, truly successful trader, and they'll tell you, without hesitation, the real battle isn't fought on the charts. It's not about analyzing indicators or spotting the perfect setup. No, but the real, defining battle is almost entirely inside your head. You can possess the most robust technical strategy known to man, the sharpest, most accurate indicators, and the cleanest, most promising setups. But if your mindset is reactive, if your emotions are impulsive, if your decisions are swayed by fear or greed, you will, inevitably, sabotage your own wins every single time. So, in this episode, we're not talking about candlestick patterns or moving averages or Fibonacci levels. We're exploring the profound mental frameworks, the inner game, that truly separate the consistent winners from the frustrated quitters, the burned-out gamblers, and the hopeful dreamers who never quite make it. This is where the real edge is found. Let's begin. Part 1. What is trading psychology? Let's start with a clear definition, because this concept is foundational. Trading psychology is simply the mental and emotional state that dictates your decisions, your behavior, and ultimately, your consistency in the financial markets. It's the silent force behind every click of your mouse, every entry, every exit. It's how effectively you handle the intense, often overwhelming spectrum of emotions that arise when capital is on the line. It's how you navigate the paralyzing fear of loss that can cause you to hesitate or exit prematurely. It's how you manage the intoxicating rush of greed during winning streaks that can lead to over-leveraging. It's how you temper overconfidence after a few good trades that convinces you you're invincible and can abandon your rules. It's how you overcome crippling hesitation after a losing streak that makes you doubt your proven system. And it's how you maintain unwavering discipline when the market tests your patience with chop or unexpected reversals. And here's the brutal, yet liberating, truth about trading. Markets don't beat you. You beat yourself. The market is a neutral, indifferent entity. It functions according to its own laws of supply and demand, probability, and cycles. It doesn't care about your feelings, your hopes, your rent, or your past failures. The market rewards structure. It rewards discipline, logic, and consistent execution. And conversely, it brutally punishes chaos. It exploits emotional decision-making, impulsivity, and a lack of planning. So, to succeed in this unforgiving arena, you must first become a master of your own emotions, not their servant. You must learn to observe them, understand them, and ultimately, transcend them in your decision-making. Common psychological pitfalls to truly master your inner game. Let's illuminate the shadows. Let's walk through 4 of the most common psychological traps that consistently trip up and ultimately ruin otherwise intelligent traders. If you recognize these in yourself, consider this your urgent wake-up call. Revenge trading. This is perhaps the most destructive. After suffering a significant or painful loss, your ego screams, "Get it back, now!" You immediately try to win it back by re-entering the market, often with a disproportionately large position. You abandon your meticulously crafted plan, over-leverage your account, and inevitably spiral into deeper, more catastrophic losses. It's driven by anger and a desperate need to immediately recover. Overtrading. This often stems from boredom, impatience, a misplaced sense of control, or pure greed. It's the compulsive urge to enter too many trades, to constantly be in the market, even when your strategy isn't presenting clean, high-probability setups. You force trades that aren't there, eroding your capital with commissions and small, unnecessary losses, all because you're trading for entertainment or to do something. FOMO, fear of missing out. You see green candles rocketing up. You hear about someone else's big win. A powerful surge of anxiety hits you. I have to be in that trade. You chase the market, entering too late at the top. Or, conversely, you exit too early on a winner because you fear the profits will vanish. You're reacting frantically to the market's movements, driven by external hype, rather than calmly responding based on your own defined strategy. Paralysis by analysis. This is the opposite extreme. You obsessively gather too much information, layer on too many indicators, and constantly seek more confirmation. You see too many conflicting signals. You hesitate. You doubt your own judgment. You constantly miss high-probability trades because you're waiting for perfect clarity, which never arrives. The market moves on, leaving you paralyzed on the sidelines. All of these pervasive pitfalls stem from the same fundamental root: a debilitating lack of emotional control combined with an unclear or uncommitted trading identity. Understanding these traps is the first step toward avoiding them and building a more resilient, profitable approach. Part 2. The profitable consistency intelligence. Now let's pivot from pitfalls to principles. Let's break down the very heart of what enables consistent profitability in trading. This isn't about finding some mythical holy grail strategy that guarantees wins every time. That simply doesn't exist. True consistency comes from mastering your edge, your unique statistical advantage over a series of trades, and then, critically, trusting it over time, even through drawdowns and losing streaks. This, precisely, is profitable consistency intelligence, the distinctive mindset of a trader who doesn't chase ephemeral results, but rather meticulously repeats the behaviors that, over a statistically significant sample size, lead to results. Let's unpack the 3 core principles of this intelligence. Key Principle 1. Process over outcome. This is perhaps the single most important shift in mindset for any aspiring consistent trader. Your fundamental job as a trader is not to win every single trade. That's an impossible, frustrating, and ultimately self-destructive goal. Your job is, instead, to execute every trade strictly based on your predefined system and rules. You must learn to emotionally detach your identity from the immediate results of any single trade. A single winning trade doesn't make you a genius, and a single losing trade doesn't make you a failure. Measure your performance not by the P&L of today's trade, but by how well you meticulously followed your rules and executed your plan, regardless of whether that specific trade was a winner or a loser. The wins will come if the process is consistent. Key Principle 2. Confidence through data, not hope. Many novice traders operate on hope. I hope this trade works. I hope I make money today. But sustainable confidence in trading doesn't come from hope or wishful thinking. It comes from concrete, undeniable data. It stems from rigorous backtesting of your strategy, from meticulous journaling of every single trade you take, and from disciplined repetition of your entries and exits. The more diligently you track your setups, your behavior during those setups, and your historical risk to reward ratios over hundreds of trades, the clearer your statistical edge becomes. This data provides the solid foundation for your confidence. And the more confident you become in the mathematical probability of your plan, the easier it becomes to consistently follow that plan, even when inevitable losses hit, knowing they are just part of the statistical landscape. Key Principle 3. Controlled risk, emotional control. This is a direct correlation. Your emotional state during a trade is almost perfectly tied to your risk management. If you're risking a massive percentage of your trading account, say 10% or 20%, in a single trade, your heart rate will inevitably spike. You'll be consumed by intense fear and greed. You will make impulsive, emotional decisions, violating your plan. The professional, consistent traders, the pros, they typically risk a tiny percentage of their capital per trade, usually 1%, maybe 2% at most. Why? Because they're not trying to hit a home run on one trade. They're playing a game of probabilities. They're trying to win over a series of 100 or 1,000 trades. They understand that trading is a game of probabilities, not perfection. When you risk small, each individual trade becomes less emotionally significant, allowing you to execute with calm, logical precision. Small losses are acceptable data points. Large losses due to emotional decisions are avoidable failures of discipline. Part 3. Identity of a consistent trader. Let's talk about something incredibly powerful in the realm of trading psychology. Your identity. Who you fundamentally believe you are will, more than any other factor, determine how you behave, especially when you're under pressure, when the market is volatile, or when losses start to mount. So, ask yourself this honest question. Do you truly see yourself, deep down, as a professional risk manager whose job is to execute a plan and manage probabilities? Or do you see yourself as someone trying to make quick money, a gambler hoping for a lucky break, or an amateur dabbling in something complex? The answer to this question shapes your entire approach. Here's what consistent, profitable traders deeply believe about themselves and their role. I'm a master of execution, not prediction. They know predicting the market's next move is impossible. Consistently executing their plan is what matters. Losses are an inherent part of the process, not a personal failure. They accept drawdowns as the cost of doing business, learning from them without emotional attachment. I don't chase the market, I let the market come to me. They patiently wait for their high-probability setups to materialize, rather than forcing trades. Discipline is my strategy. Profit is merely the byproduct. They understand that unwavering adherence to their rules is the path to long-term profitability. This mindset isn't just motivational fluff or positive affirmations. It's the very foundation of consistent profitability. You simply cannot be consistent with your profits if you're inconsistent with your behavior, driven by fear, greed, or impatience. Your identity drives your actions, and your actions drive your results. Daily rituals of consistent traders. This powerful identity is built and reinforced through consistent daily rituals. These are the non-negotiables for anyone serious about mastering the inner game of trading. Morning prep. Before the market even opens, they meticulously review key levels, mark their zones of interest, and quickly check for any major news events that could impact their instruments. But even more importantly, they check their own emotional state. Are they calm, clear, rested, and ready to execute? Or are they agitated, anxious, or rushed? This self-assessment is crucial. Defined trading plan. For every single trade, their entry point, their exit strategy, take profit, their stop loss, risk limit, and their exact risk per trade, e.g. 1% of capital, are all meticulously defined before they enter. They also set a maximum number of trades per day to prevent overtrading. For a consistent trader, no plan literally means no trade. Post-trade reflection. Win or lose. After every single trade, they pause for reflection. They don't just move to the next trade. They ask themselves, did I follow my rules precisely? What did I feel during this trade? And how did I manage those emotions? What, if anything, would I do differently next time, based on my system, not the outcome? This is how learning and adaptation truly occur. No trading zones times. They consciously step away from the charts after suffering a defined number of losses, e.g., 2 consecutive losses or reaching a daily drawdown limit. They also step away after significant wins to prevent overconfidence and chasing. They understand that emotion, not opportunity, often drives subsequent decisions. They create clear boundaries for their trading sessions. Part 4. Long-term consistency. Let's be honest, consistency isn't sexy. It's not glamorous. It's often repetitive. It's even at times a bit boring. It's profoundly simple in its concept, but it is incredibly difficult in its execution because it demands unwavering discipline. The journey of long-term consistency in trading looks like this. You show up every day, prepared. You follow your plan meticulously, without deviation. You take losses with grace, understanding they are part of the game. You don't overreact to market noise or short-term swings. You don't chase trades out of impatience or greed. And, crucially, you evolve. You continuously review your data, refine your understanding, and adapt your system without abandoning your core principles. Here's what definitively separates the consistently profitable traders from everyone else who attempts to conquer the markets. They journal every single trade, meticulously recording their entry, exit, reasoning, and emotional state. This is their invaluable learning tool. They review their weekly and monthly stats to identify patterns in their performance and areas for improvement. They sit out when the market is choppy or unclear, understanding that capital preservation is as important as capital growth. They prioritize patience. Most importantly, they treat trading like a serious business, not a casino, not a hobby, and certainly not a get-rich-quick scheme. They approach it with professionalism, planning, and a long-term vision. You want to make consistent money every week? Every month? You want to build sustainable wealth through trading? First, and most importantly, ask yourself this: can I consistently follow my system, meticulously, without breaking my own rules, for 30 consecutive days straight? If your honest answer to that question is a resounding yes, then, and only then, will consistent profit inevitably follow. If your answer is no, then nothing else, no new indicator, no new strategy, no amount of market news will truly matter. Your inner game must be mastered first. As we wrap up this insightful session, please carry this powerful truth with you. Mastery in trading is ultimately not about predicting the market. It is, profoundly, about mastering yourself. The charts will always be chaotic. The market will always be unpredictable in the short term. Your job, your ultimate advantage, is to become the unwavering calm in the storm. So, prioritize working on your mind. Diligently work on cultivating healthy habits and bulletproof discipline. Build your profitable consistency intelligence. It is the true superpower in the financial markets. This is Inspire 7, and today you just sharpened your most important edge. Until next time, trade smart, think sharp, stay consistent, and stay profoundly inspired.